Okay, let's get some questions and answers from Sunday's market outlook. First one, short answer. I'm really not close enough to this situation to know about it. I don't really know the details, so I can't give you the fine details. Can we get your thoughts on the Credit Suisse and Deutsche situation? Well, for Credit Suisse, if you look at their last quarterly report, you'll see revenues are down significantly year over year, but expenses are up, which seems rather odd. Most of the expense increase is probably for wages, because we know that wages have increased significantly almost everywhere. So those are up. It's also a diversified bank, but it had a lot of focus on issuance. And that market seems to have shrunk more than I guess you would have anticipated, given what's going on in the world right now. So when you have less diversification, more concentration, dropping revenues, rising expenses, layer on mismanagement, and you get what you get. And that's about as far as I can go on that one without, spending a couple of days and really getting into the intricate details. And a lot of any situation is history, is how did they get to this particular situation. And sometimes you get to a situation through what seems like rational steps along with some exogenous events. I know Credit Suisse took a big hit from Archegos when it failed, and that was probably a lack of governance there of how Archegos could have done what it did without the banks being more aware of it. But there you are. So what are they going to do? Well, they got to raise money, because you got to restructure, you got to lay off people, you got to cut staff, and you need to sell assets. So that's probably what they're going to do, because with the stock price so low, I guess for both of them, with the stock price so low, you certainly don't want to issue equity, but you need capital. And when you can't issue equity because, well, at these low prices, it's going to be super dilutive. If that is really not an option, you're going to have to find some way to shore up your capital. And that means let's get rid of some expenses, especially if revenues are down, expenses are up. You got to find a way to get rid of that, and sell off some things. So look for them to do that sometime in the future. I think probably in the near future, not the long-term future. Problems like this, the more, if nobody knew about the problem, it really wouldn't be that much of a problem. It's a problem that could be solved on its own, but as soon as people start talking about the problem, as soon as it shows up in the news, I got a bank account at Credit Suisse, or I got a bank account at Deutsche Bank, I got some investments there, I may start to get nervous. So you might see capital flight, which means that, just the reaction to the news could create the problem that doesn't yet exist, if you follow me on that one. Next one, do you mind explaining how stock market increasing influences rates going down? Well, it's not that a stock market increasing will force rates down. It's just the correlation right now between stocks and bonds is positive. It's greater than zero. So that if I see the market going up, I can probably look over at bonds and see bond prices going up as well, because that correlation is still in play. And if the bond prices are going up, yields are going down. If rates at 4.22 and you said the stock market rally pushes it down to 3.7, I'm not 100% stock market rally is pushing the rate down. It's not that the rally is pushing the rate down. It is what is causing the rally would be the same thing that would push bond prices up. The rally right now, everything is all about the Fed and when they're going to stop their rate hiking cycle. And even the word pivot is back on the table, but it's in the phrasing of they'll be forced to. The market will force them to pivot. And we've seen the Bank of England step in to buy gilts. We've seen Australia not raise rates as much as they really should have. But two other central banks did, with one raising rates more last night. So, we have a negative, ugly day today. I don't know if that had any influence on it, or if it's just the ugly PMIs that we got out of Germany. But the optimism is what fuels rallies. It's the optimism that rates will be near an end. So, well, why not pick up bonds in anticipation of rates topping out or even rates dropping if the Fed has to? Why not pick up equities? Because lower rates, higher present value, future cash flows, etc. So it's not that one causes the other, it's just that they're correlated right now. When stocks increase, I would assume market is selling bonds. You would assume that, but that's a typical relationship. But since the great financial crisis, with the Fed intervening in bond markets so much, that negative correlation between equities and treasuries, it was slightly negative, but that negative correlation is now gone. It's been a positive correlation for the last, 14 years now? Next one. What do you make of AD's view on the Fed and the actual effect of its monetary policy? And what he is saying is, I agree with what he's saying to a certain point. There was another paper a while back by I forget who it was. It was out of Europe, arguing about the Fed put now becoming a Fed call. And in that paper, he gave a lot of credit to the overnight rate to affect things, and I disagreed with that. I said, the writer is giving way too much credit for the rate to actually affect things. But I do think it might be worth looking at what exactly he's saying over here, so we can see where we would agree and where perhaps there was a confounding variable that was not accounted for that might have explained some of the effect that he had found. Okay, I'll put a link to this in the description box, and you can read most of it yourself. I'll just describe the charts. What is this chart doing? He is taking a 10-year bond rate. This is a nominal bond rate. And he's comparing it with the height of the bars. So you have to look at the total height of all of the bars. And he breaks the bars down into a real and an inflation component. But it's rather interesting, and I'm not quite sure exactly what his rationale for this is. The red bar here, you can see it says inflation rate, but it's an inflation expectation. See up here? It's the sum of real growth in GDP and expected inflation. So if it's expected inflation, it's a forward-looking measure. And he compares it with real GDP. Well, is it real GDP year over year for the past 12 months? If it is, that's a backward-looking measure, not a forward-looking measure. That would be combining a backwards-looking measure with a forward-looking measure. And since the nominal yield on the 10-year is for the next 10 years, it's the yield over the next 10 years, it's all forward looking, I would seem to think that you'd want a forecast of real GDP growth along with a forecast for inflation to make all of this forward looking. In which case, if you are taking a forward GDP, real GDP, and forward expected inflation, it's nothing more than forward nominal GDP, your expectation for what nominal GDP will be, which is just your best guess. And the 10-year yield is the market's best guess as to what the cost of time and what the cost of certain maturity term premiums and certain premiums for inflation uncertainty. The uncertainty is to the expectation. That would be everybody's best guess, which is exactly what everything in a market is. It's everybody's best guess as to what the future is going to be. But if it's backwards looking combined with a forward looking, I'm not quite sure why we're calling that a fundamental interest rate. Now, to be clear, I'm not saying I disagree with it. It's just that if he were in front of me, I got questions, right? Let's see. As you can see, the Fed's role over the past 5 decades has been more of a tweaker of interest rates rather than a setter of rates. Well, now, they do set the overnight rate, and they do engage in open market operations to make sure that that overnight rate stays within the target band. And since that is the price of, or at least that's the overnight rate, any rate beyond that should reflect that. If there were no term premium and there was no uncertainty as to the inflation expectation, then you can draw a straight line from the overnight rate straight out, and you'd have a flat yield curve all the time. You typically have an upward sloping yield curve because of a term premium, because of some expectation for inflation. And then, of course, the longer out you go, the more uncertain you are about that inflation expectation. Typically, you'd have upward sloping yield curves unless you felt that there was a recession in the future. Recessions kill inflation, so the further out you go, the lower the bond yields would be, hence your downward sloping yield curve. If we, so I don't know if I would say it's a tweaker of interest rates. It does set the overnight rate, which then does cascade down the maturities to all the other maturities. Now, all the other maturities, other than the overnight rate, all the other maturities are market determined. Even the overnight rate is market determined. It's just the Fed is the market. The Fed, right now we have rates, the band is 3% to 3.25, which means it will step in and borrow money at 3% and lend money at 3.25%. So if you can borrow from the Fed at 3.25, why would you ever pay anyone more? And if you can get 3% on your investments at the Fed, why would you accept anything less? So it is a big market participant in the overnight, at the overnight rate. Sometimes it steps in and buys bonds in other places on the curve. So it is a market participant in that sense. Bank of Japan sets rates. They're sitting on the 10-year at 0.25. So I don't know. It says over the past 5 decades, they've been more of a tweaker of rates than a setter of rates. If you go with the premise that, well, they only really control the overnight rate and the market controls everything else, okay. But the overnight rate is a major input into what all those other rates would be from a levels perspective. We can say that. It is here, it is undeniable that the Fed can affect rates at the margin. Okay. There we go. We're on the same page. In particular, the Fed's quantitative tightening in 80 and 81 and easing, okay, have had an effect on interest rates. Yes, they have. The figure below, I try to capture the Fed effect by looking at the difference between the nominal 10-year T-bond and the fundamental interest rate. And here again, I'm thinking, well, just taking the difference between these two. So here we would have negative differences here. You'd have some positive differences over here, some negative difference here, positive differences. And that's what we're seeing, some negative differences here, turning into positive, turning into negative. And he's comparing it with the Fed funds rate. Well, we got to take 1980 here and draw a straight line at 1980. Notice that before 1980, lots of divergence. After 1980, a much tighter correlation here, right? Before 1980, I don't know the exact date, 81, 82, 1980, I forget what the exact date was. There were some changes in banking. Banks were limited in competing for deposits by offering depositors higher and higher deposit rates. They were capped at 5%, so that money would have to find its way into other things, because banks could not compete for deposits. So they would find their way, well, into fixed income, right? So you may have had bond yields that might have not reflected the true reality of the situation, only because you squeezed all that money out of the banking system and it went for higher returns somewhere. Had the banks been allowed to offer more than 5% on their deposits, well, then they would have. That was, this whole period here was probably the biggest catalyst for money market funds. Banks were then saying, well, if we can't offer you more than 5% on your deposit, hey, let's create some funds. And then we'll buy up, your money will go into the bond market. Well, if it's going into the bond market, it's going to have an effect on earlier rates, on money market rates, which will then have an effect on the 2-year, the 3-year, the 5-year, etc. So I think you have to look for the confounding variable in here to explain a lot of this divergence, whereas here you have a lot more correlation going on. Note the negative values are loosely indicative of easy money and a positive values with tight money Fed. Using a measure, again, that I got a question about, because if you're using a 12-month trailing real GDP, but a 12-month forward inflation expectation, it doesn't seem like a coherent number to me. So I'm wondering exactly what it means. And if we say, wow, look how nice this is, and look how, look how closely this tracks, I can find things that are unrelated that track well only because in an economy, so many things are interrelated. In financial markets, so many things are already highly correlated to begin with that you can sometimes come up with relationships between variables that have no explanation at all, only because, well, everything you're working with is all highly correlated to begin with. Let's see what the conclusion here is. Make argument Fed actions kept rates lower than they should be, at least for the last 3 years. If you accept the notion that the Fed controls interest rates, or even my lesser argument that the Fed has used its powers to keep rates below where they should be for the last few years, the consequence for valuation are immediate. Exactly. Lower rates will push up the valuation of all assets, yes, but the lower rates have a higher value impact on cash flows way into the future than they do on near-term cash flows, making the overvaluation larger at higher growth companies. Yes, I've said that in past market updates, that when you have a situation like this, you describe those firms as having high duration, high sensitivity to interest rates. A reasonable argument can be made that the Fed has been an active participant in and perhaps even generator of any bubbles, real or perceived, in the market. Yeah, I think so. A lot of people attribute the housing boom of 2005, 2006 to the super low interest rates that Greenspan had set at the Fed at 1%, that it spurred that kind of activity. And for the pandemic, when they cut interest rates and started buying up bonds, I put out videos saying this is going to squeeze money out of the bond market. It's absolutely going to squeeze money out of the bond market. Go big on equities and do not short this market, no matter how what the economics, the fundamentals of the economy look like. Don't short this market. Yeah. I've been saying that for a long time, that the Fed and government keep screaming at inequality and bubbles, but you guys are the very ones causing it. In March of 2020, I think we got to May. By the time we got to May and the Fed was announcing all of its interventions, in the videos I had put out, I said, listen, when the Fed acts, the investor class gets paid first. When the government acts, the worker class gets paid first, then they run to the malls, and then they give it to the investor class, but we get it in the end. It just has to go through households first. But whenever the Fed does anything, the investor class always gets paid first. So I would get upset with statements like the rich only got richer, like somehow we manipulated things to get that. No, that's not the point. You basically gave it to us. You told us what you were going to do. You said we got your backs. You gave us permission to load up and go in, and that's what we did. You created the very inequality you're screaming about. So I've been saying that for a while, so we're on the same page here. Anyways, I'll leave the rest for you to read. This part here, I'm not quite in agreement with this one here. This is the implied equity risk premium from year to year, implied. But markets didn't, I wish there would have been an actual return, not just the expected or the implied, but the actual return on here. But anyways, there you go. I'm not sure if that answered the question, but okay, next one. Jeffrey Gunlock believes the U.S. economy would be better off having the FFR mirror the 2-year Treasury yield, which would avoid Powell's mistake of initiating rate hikes too late. What are your thoughts on this? Well, this is kind of like complaining about a feature only when it works against you. It's like, I'm in favor of free speech unless you're saying something I don't like, then I'm not in favor of free speech. So free speech for me, but not for you. This is kind of the same thing. He's been very vocal about the Fed since the Fed has begun its rate hiking. But when rates were held low for a long period of time, when the Fed cut rates and pushed up asset prices, I didn't hear him complain about anything. So, I guess that's the best answer I can give right now. look at every advantage has a disadvantage. Everything has another side. So what helps you one day may be the very thing that hurts you the next day. Well, complaining about it when it hurts you and being silent about it when it helps you is more about you than the actual tool itself. So let's just leave it at that. Could you please explain why the euro was more valuable than the US? I don't know if it was more, I don't know if you can say that it was more valuable than the US. You needed more US dollars to buy it. It was more expensive than a US dollar, but I don't know if it was more valuable than the US throughout the 2000s, 2010s, considering the American economy is so much bigger, stronger, and US interest rates have generally been higher. Well, saying something like this is like looking at stock ABC at $10 and looking at stock XYZ at $100 and saying, but why is XYZ so much more expensive than ABC when ABC is the better company? But you may find that ABC has a market cap of 20 billion and XYZ has a market cap of 100 million. You have to consider not just the price that you see, but you have to consider everything else. Well, what are the shares? How much is out there? What's the sum total of everything? So when we look at two currencies, you have to say, well, what is the ratio of the money supply to GDP? What are the amount of bank reserves? What's the purchasing power between the two currencies? Is there purchasing power parity? Is it possible that by the time you take a euro and convert it to US dollars, you're buying a Big Mac meal in the US, but the same amount of euros bought a Big Mac meal in Europe? There's equal purchasing power parity? It doesn't stand. There's no reason why they have to have the same value. They don't need to trade at par. And sometimes trading at par creates goods arbitrage, where it makes sense to buy your goods in another country, import them into yours, and sell them there because your currency is so strong. So you have to try to say, well, listen, there's a lot of things that affect the value of a currency. Trying to control for all of them to be able to say that one is more valuable than another. You can say the price of one is higher on a relative basis. You need 1.1 euros, let's say, or 1.1 US dollars to get a euro. Does not mean the euro is more valuable. It just means in terms of US dollars, it's more expensive than a US dollar because I can buy a US dollar for 1 US dollar, but more expensive doesn't mean more valuable. XYZ is a more expensive stock than ABC if we look at it in terms of price, but it's less valuable overall. In this week's Q&A, could you please address which apartment REITs you're looking at? Apartment REITs are, I'm in Canada, right? And we do have a tax treaty with the U.S. If I buy U.S. stocks in registered accounts, like, well, not my TFSA, sorry, any retirement account, so my RRSP and my LIRA, which is a locked-in retirement account, and this is a registered retirement savings plan. Then I don't have any withholdings from the U.S. However, if I hold a U.S. REIT in my taxable account, I have fairly significant withholdings. I think on REITs it's up to 30% because it's non-qualified. It's a non-qualified dividend as opposed to just 15%. So U.S. REITs, I usually use synthetics, and I'll only if the REIT does not have options, it makes no sense to use. Because if I use a synthetic, which means I'll sell a call, or sorry, I'll sell a put and I'll buy a call. The dividend is reflected in these if I use a synthetic. That means the present value of the dividend is within the premiums that I get. So I get all the dividend up front and then whatever price movement goes on. So the dividend is now smuggled in as a capital gain at that point. So now I have a capital gain in this one, because the call will be cheaper than it should and the put will have a lot more premium because of the present value of all the dividends. So Avalon Bay is a long-term one in the US that I've liked, AVB. That's really about it, because I do have to be concerned about that withholding. So in the Canadian space, CAP REIT, which is CAR, it's called CAP. It's Canadian Apartment REIT. Canadian Apartment REIT, CAP REIT. So CAR, and then you add the .UN to it. CAR I like. It has a net asset value per share of around $55, $56, trading at 42, with a very decent share buyback plan in place as well. I like Minto, mi.un, and I like Interrent, iip.un, and on East Coast, Killam, kmp.un. Canada only has 6 apartment REITs, only 6. The only one I think that I don't have a position in, sorry, it had 6, because Northview Apartment REIT I had for a long time till it got bought out by I think Starlight and Kingsit. I think it only has 5 now, and I've got 1, 2, 3, 4 of them. The only one I don't have is Boardwalk, bei.un. It has heavy Alberta exposure, and when there was sort of a hollowing out of the oil sands projects, their rents, just weren't surviving that well. I just didn't see a lot of growth in that market, so I still don't have BEI, but it's a $40-some per share. It does exist. It's just I've never really been interested in it. So Minto is around the Ottawa area, IP is Toronto, Golden Horseshoe area, KMP is East Coast, CAR is right across Canada, and it has some foreign exposure as well. In the US, it's really just Avalon Bay that I think is probably the best of the best out there, with options that are decent enough that I can use. They're still not great. Most apartment REITs don't have really great options. These 3 have no options on them at all, whereas this one does have options, but usually when you get to apartment REITs, the options are not really that great. If you're going to use them, you're pretty much going to hold them to maturity. By the way, in the applied series, the real estate sector video is up this week. Part 1 of it is up. It's quite long, and in part 1 I really go through apartment REITs a lot, and we do actually look at the financials for CAP REIT to make a whole bunch of points about what it is that we're looking for when we're interested in apartment REITs. CAP REIT does a very good job of giving us that information. All right, given these positive real rates and low break-evens, I guess this is for the U.S. market. Market is pricing in inflation back in the 2s longer term. Yeah, it is. Suggesting long-term growth expectations should also be more pessimistic given the expectations of a pending recession. I'm not sure if this statement follows from the previous statement. I would suggest long-term growth expectations should also be more pessimistic given expectations of a pending recession. Yeah, I would agree to that. My thinking is yields are stubbornly high on the long end due to central banks such as Bank of Japan and BOE intervening to support their measures. Well, BOE intervention has nothing to do with real rates or break-evens in the U.S. The BOJ, we're not even sure if they did sell treasuries to get the job done, because they do have lots of reserves. So they might have used reserves before they tapped their treasuries. We're not entirely sure. Haven't seen a recent statement showing any changes in their holdings. But no, I don't think I would agree with any of this. I don't think I'd agree with yields are stubbornly high on the long end when you have the overnight rate at 3 and 3.25. You have a 2-year around 4%. I don't know that saying that you have 4% 10-year is stubbornly high. So no, I'm not sure where you're going with that, but no, I don't agree. I don't agree on that. On BOE gilt intervention, I don't follow why pension funds must use derivatives. If the maturity of the liability is 40 or 50 years, why not use assets of equal maturity to achieve immunization? There are gilts with maturities of 40 to 50 years as well. Well, we don't know if they don't have any of those. Maybe they do, but to use this, you need issuance. Number one, you need a big enough issuance to keep satisfying the demand for these, and you need liquidity. So if you have small issuance, and this is only issued at certain times and the issues are small, you're not going to have any liquidity at all, which means they're not going to be very useful. So on this front, there's no explanation for using the 30-year. Well, you use the 30-year probably because the issuance is higher and it's a more liquid pool. If their choice is to use 30-year gilts plus derivatives to achieve immunization, this could be done without the risk of a margin call if these derivatives were fully collateralized. Well, to fully collateralize, why not just buy the 30-year gilt? Buy futures while keeping the cash in short-term paper. There's a belief that, well, if you keep the cash in short-term paper, you're going to get the short-term yield while you have the return on the futures. But remember, a futures price is the spot price carried at the interest rate for that period of time, whatever the interest rate over that period of time is. So you're already buying the futures at a price much higher than the spot. So putting your money in short-term paper, the yield on short-term is not going to be the same yield on this. So you would actually, this money here would actually be an underperformer. And you're doing it just to have liquidity, which means you're paying for your liquidity just to avoid a margin call by fully collateralizing. And if you're fully collateralizing, why not just buy the 30-year gilt to begin with? You'll get the higher yield on that as well. One of the reasons is you don't have the money to get it done. Remember, we want to get the basis point value of the assets equal to the basis point value of the liabilities. And basis point value is market value times duration times 0.0001 to get to a basis point, right? This is just dollar duration, but that's a big number, so you just get it. Well, for both the assets and the liabilities, this is a common term. We can get rid of this. We know that the duration of the liabilities is much, much greater than the duration of the assets. So to get this done with 30 years, you would have to have the market value of the assets significantly higher than the market value of the liabilities, or the present value of the liabilities. Well, that's a cash constraint. Maybe you just don't have that much money on day one, so you simply just can't get it done. With that said, isn't it fair to conclude that the BOE was using leverage? The pension funds were using leverage to fully immunize its duration exposure, using only a small portion of its assets so that they could invest the rest in asset classes with higher expected returns. Well, when you follow an immunization strategy, what you have assets and you have liabilities, right? Your liabilities are most closely aligned with what are corporate liabilities, so there'll be a corporate discount rate on those liabilities. The assets can be in any portfolio you want. You don't actually have to immunize. You don't have to engage in liability-driven investing. You could just say, hey, forget that. We're just gonna invest the way we want to invest. If you are engaging in liability-driven investing, you are trying to achieve this condition. Now, is it possible that out of $100 of assets, had they been all in bonds, they might have been able to get that done, instead of saying, well, let's put $60 in bonds, we'll put 25 in equities, and we'll put another 15 in alternatives, which is what pension funds do. They will step out on the risk curve and do that kind of thing because they do have to get a higher yield than what bond yields are offering, only because everybody sat on the yield curve for how long? There was no return. You pretty much had to step out and take risk. So I don't know that I would blame the pension funds for taking risk as much as I would blame central banks for creating the conditions under which you force the pension funds to step out and take risk. And, you know, with interest rate variability or volatility so low for so long, it made sense to do that and achieve this using a derivatives overlay. It is when rates change dramatically that you end up with a problem. So when you invest under one type of regime and that regime changes, there's going to be dislocations. And those dislocations are going to be worse the more correlated the strategies are. So if you have pension fund 1, 2, 3, 4, all the way to pension fund N, all doing the same thing, when one has to change because of changing conditions, you have correlated strategies all the way through. They all have to change, and it's that rush for the exits or the rush for the entrance that creates those problems. That the BOE could not see that ahead of time and advise the government that what we need is low volatility here. Let's be careful about what we do, because anything that introduces volatility will destabilize something. That they didn't see that would have been the outcome, I think is rather short-sighted. All right, next one in 4 parts. Can you give some more insight on how you time when exactly to enter into these trades? And this is a question about the October SPY short calls. On the updated video, on the market outlook, I said I sold 378s and 382s. And yesterday I sold some 380 calls as well. When you get a 200-point rally in a day and a half, you sell calls. When exactly to enter these trades? Once there's a run-up intermediate rally after some positive sentiment enters the market, which you think is essentially unsubstantiated. How do you time when exactly you enter into the trade? Are you watching IV on a day-to-day basis, or that the IV is higher than historic, or is it very much a guess? No, I'm not too concerned about the intrinsic the implied volatility on the option in relation to what historical volatility was, and if it's out of line. I'm not looking for a volatility trade. I'm not looking to say, well, I'm going to arb volatility here because the implied is much, much higher than historic, so I'm going to play the odds on this. It is primarily, first and foremost, a delta play, in that I want to add negative delta. I'm not too worried. It's not a theta play. I'm not doing it because you talk about theta a little later on. I'm not doing it as an income trade, because if it were an income trade, I'd be choosing deltas of about 0.2 on this one. When I do these, I try to find deltas of around 0.5, which is not at the money. So if SPY is sitting around 377, the 0.5s calls are right around 380. So I'll be looking for 0.5s on big strong rallies like that, which is the same as shorting 50 shares of SPY, except at 380 I'm getting premium, so my break even might be as high as 390, 393 yesterday. So 377, I don't actually lose till it gets to 393, whereas if I shorted 50 shares here, I'd start losing right away. So it's more of the delta. When it's a delta play, it's how many deltas do I want to add. If it's a theta play, well, then I'm looking at how much theta decay can I get. What percentage of my portfolio should be dedicated to theta decay. And if you're new at this, you should be targeting 0.5% as your theta decay per day. If you're experienced at this, you can go as high as 1.5 to 2% per day. So you'd be sizing your trades and placing your bets with a much lower delta, such that you don't exceed a certain percentage per day. If it's a delta play, I'm really only concerned, I'm looking at the delta of the option itself. Why did I do it yesterday? Why did I add 380s yesterday? Is because you had significant run up. You had a 200-point rally in a day and a half the BOE intervened and Australia didn't raise rates as much as they were going to. Everything is slowing down, hence the Fed is going to slow down, and we're pretty much near the end of the cycle. Plus you started from an oversold condition with high short interest. I showed you the short interest on SPY on Sunday was sitting around 20%. and you had short interest on a bunch of other ETFs running around 40-45%. Well, you just need a run-up in stock, and the weakest hands will start their short covering, which then pushes the price of stock up even more, which then causes the next layer of weak hands to cover their shorts. And then, of course, there's buying because you don't want to miss that rally, which then causes more short covering, and up and up and up you go. If the market were a little bit smarter, which it isn't, what you would find is as the market dropped, short interest would drop. As the market rose, short interest would increase. But that's not how the market works. Short interest drops on the way up, and short interest increases on the way down. So the further down you go, the higher the short interest, the more likely you are to get a short covering rally out of that, because you just need a catalyst. And since information appears in the market randomly, good and bad, randomly, you never know when it's going to happen. I don't only have calls, by the way, I have puts. So as the market is dropping and short interest is increasing, I think I'm going to sell puts. And as the market is rising and short interest is dropping, the first thing I do is I start slowly covering the puts that I sold, and then I start introducing calls. And then once it rolls over, if it gets down far enough, I'll start covering these calls, and I'll start looking at new puts. All the time I'm deciding, well, what is causing this and what is causing this? So Monday the market ran up, but it hit the highs into the close. There was buying into the close. So I did not sell any calls on Monday, because I said this is going to spill over to the next day. Whenever a market has a big day, and it's hitting the highs into the close, there's buying into the close, that doesn't disappear overnight unless there's some big negative event. Well, I looked around at the calendar, and I didn't see anything too significant. So I said, okay, well, let's let it go for tomorrow. If we have a pop tomorrow, I'll do the same thing. And sure enough, we had a big pop the next day. And that's how I do it. So if we're looking for how, it is experience, intuition, just a feeling. Okay, I don't feel that this is right. I feel that given the speed at which this is recovering, given the length at which it has gone, 200 points in this short period of time, this doesn't feel sustainable. It's more experience and intuition. You selected 2 strikes. Do you sell more for one than the other? No, I don't. No, I don't. I'll step in at a 50 delta. There we go. Market moves up even more. Well, the 378s are no longer 50 delta. At least when I sold these, they were no longer 50 delta. 382s were 50. I keep selling at a constant 50 delta. If I don't believe on what's going on, that's where I'll sell the calls. I keep selling. Not that I keep. I don't always use 50 delta, and I don't always keep doing it. It's just I decided that that's what I was going to do at that time. Same with this one. The 380 was a 50 delta, and I stood ready today to sell higher at 50 deltas, because I don't think that this is anything more than a lot of short covering. Are you selling options here? I understand you're selecting October because that is near term, and we want theta to work in our favor. Well, theta is always a nice thing, but this was not a theta play. If it were a theta play, I would have went higher. I would have went with a much higher probability of winning on theta, and I would have sized it according to how much money I'm dedicating towards theta plays. So let's say that I carve out part of my portfolio and I say, okay, $50,000 is available for theta plays. Well, 1% of that is $500, right? So I would target a theta decay. I would set up my short options in such a way that my theta decay per day was about 500 per day. That's aggressive. Going higher, you pretty much have to be very skilled at that, which is why I say if you're just starting, you'd start at 0.5, you target 250 a day on your theta decay, knowing that some of them are not going to work out, right? And especially once you get into very volatile markets, well, then you're taking on gamma risk with that theta, so you want to probably get smaller, like around the 250 to 5. You certainly wouldn't push up to the 2% unless you were very good at what you were doing. Okay, so we can specifically with trades like this, is your aim to completely neutralize your SPY delta exposure? No, I don't. I'm actually taking on. I don't have any long position or short position in SPY itself. Everything I do is with options, and I do it because I have, stock 1, 2, 3, 4, 20,000 shares here, 35,000 shares here, 10,000 shares here, and they have a certain beta, and there's a certain dollar amount, and they all have a delta equal to 1. So if you multiply it out, you get dollar delta beta, and then I use these to either lower this exposure or to raise this exposure. So as we're rallying, I want to lower my dollar delta beta, and as we're selling off, I want to increase it. And that's it. Okay, does it make sense to take the 10-year average of the S&P multiple of 16.5, considering that we had a risk-free rate for the 10-year U.S. Treasury around 2% for most of the time for the last 10 years? Multiple of 16.5 leads us to a yield of 6%, which is an earnings yield. Let's just be clear what we're talking about when we say yield. An earnings yield of around 6%, which gives us around 4% of risk premium for equity. If we accept a 2-year rate as a long run rate, 2%. If the risk-free rate trends around 4% now and risk premium for equities around 4, this would give us a yield of 8%, or lead us to an earnings yield of 8%, or a multiple of 12.5. Okay, so you got this is a small word, if, but it's the largest word in the English language, if, because it sets up a condition that your conclusion is true if the condition that starts with if holds. If the risk-free rate trends around 4% now, well, that's not the belief, is that it'll trend around 4%. Right or wrong, that's just not what the belief is in the market. If we had PE multiple expansion, while you had a 10-year yield going up, we could easily conclude that one of these things are wrong. Something has to go. But from the beginning of the year, we've had multiple on the market go from 21 down to 15.5 as of last Friday, while the 10-year went straight up. Well, these are going in the right direction. Things don't just snap into place right away. So they get there, and everything is forward looking. So when you're at this multiple on the index, let's say 15.5, the thinking is, well, what lies ahead? And same with the 10-year yield, what lies ahead? And each one will adjust for what it thinks lies ahead. The direction are correct. You may disagree with the current levels right now, but the directions are correct. So it's not so clear cut to say, well, hang on a second, shouldn't we be at 12.5? If the 10-year continues to rise, then yeah, I would say that the multiple should continue to fall. But if the 10-year decides to go sideways for a while before we drop, well, then the multiple would probably go sideways for a while before it increases. Whether 16.5 using a 10-year average is appropriate, I don't know. I haven't really done a lot of thinking on this one, but I will say this: the market prices of things every so often get shocked by events that are outside of the psychology of the market. And whenever we buy and sell, we always are thinking about what we're buying and selling relative to some kind of anchor that we have that we think is a good price. So over time, the market becomes anchored to certain numbers, and moving people away from that anchor does take some effort. To get them to re-anchor to a new level, that takes a significant dislocation. So if you have a massive recession, well, what's the central bank going to do? It's going to go back to the zero line. If it's going to go back to the zero line, then yeah, that is appropriate. If you don't have a massive recession at high levels, if the economy keeps chugging along, I don't know if it's enough to move the anchor away from 16.5. So at this point, I would say the most recent past is probably the best influence on today's behavior than something 30 years ago. You have to also consider the number of the market participants over the past 15 years that have known this. You have 15 years of new people that have entered the market who have only known this, and 15 years of people who have known, the 70s and 80s that have left the market. So there's less of a memory to market participants as to what things used to be. For example, the person I am today is heavily influenced by the last 5 years of my life than the 5 years of my life from 15 to 20 or from 20 to 25. So you could say, this is how you looked at the world, or this is how you behaved, or this is how you acted, or these are the things you did, or what you were interested in at 25. I don't see that in you anymore. Well, it's because I'm more influenced by the most recent past, and almost everything is influenced by the most recent past. Once we start jumping over the recent past, well, for many people who only know this, that becomes a new regime and a new anchor. Psychologically, that's hard to get people to do without a major dislocation. People will anchor around the 16.5, the 15.5, that's fine. Based on what we have going forward at this point, I'm not ready to say the market is ready to move to a new anchor at this point. So I'm not sure if that answered it, but some things don't have, finance answers. Some things are more behavioral or psychological. From the past video, I've been wondering why take a position in HXB, which contains home building products like home improvement, household appliances, which should see a decline in this recession. That is true. Customers want to take unfinished basements. The finished one doesn't contradict HXB bet. That doesn't contradict what I'm doing. I had explained last time that I used a farmer's analogy. If you have 3 seasons that you can harvest in, let's say that you're in a zone that gives you 3 seasons, you'll be harvesting one field while the other field is growing, while you're seeding this field. We're over here in the market, and HXB belongs over here. I'm just seeding the field. Why? Because I don't know when it's going to recover. I don't know what's going to happen in the economy. I do know that we are facing a housing shortage, and they have to be built. Housing has to be built. In both Canada and the US, we have a housing shortage. There's been underbuilding for a long period of time. When is the bottom? I don't know. Neither do you. Nobody knows. When is the right, here's the thing. You're never ever going to buy everything right at the bottom and sell everything right at the top. So if we think of prices as doing this, that's exaggerated. Your best bet is you can average in and you can average out. You're trying to capture enough of the run that makes it sufficient, but you're never consistently going to buy at the lowest price and sell at the highest price. You have to start thinking, what is going on today and what am I doing today? What is working today that I don't need to touch, and what should I start doing today such that in a period of time I'll be in a good position? Hey, listen, the war in Ukraine could end overnight. Somebody could assassinate Putin. Putin could come to his senses. Who knows? It could end overnight. You being out of positions or short are going to get crushed on that one. So when I did this, I said I was taking a 10% position. I'm just seeding a field that I know is not going to be ready to harvest for another 5, 6, or 7 years. But I don't know where the bottom is. But I'm willing to take a 10% position now, and then, in time, I'll look at the options. I'll look at the environment, and I'll say, well, what do I want to do now? HXB has held itself up fairly well. I have shares of it. I've sold upside calls, and I've sold some downside puts. I now have a straddle on it. I'm comfortable with that, and I will slowly build myself into a position. Actually, I think on HXB I took a 25% initial position because I bought HXB and I immediately sold the straddle on it to get my next position. Yeah, I think that's what I did. I have so many positions open right now because so many things are going on. I don't quite remember, but I'm comfortable holding my HXB. And if it drops, if we have another sell-off, which for many of my positions, I am hoping for a sell-off in some of them. Even though I'm long, I am hoping they drop because I do not have a 100% position. Let's finish up the rest of this. If your bet is on real estate and rentals, why not go XLRE, which is the SPDR ETF on the sector, or VNQ, VNQI, or even FREL. This is Fidelity real estate. Not really worth it. The options, you look at the, you'll have 0.40 to 1.50. That's your bid-ask spread. That's you can't use that. XLRE has fairly wide spreads as well. IYR has as low as 3-cent spreads on certain strikes, up to 8 cents if you are more illiquid on the strikes. So IYR has much more liquid options, and it's a much larger ETF in terms of the number of components that it covers. XLRE is just the S&P 500 components. Most REITs are small cap. Most REITs are small cap. So they wouldn't even show up in the XLRE. So the XLRE is not as representative as something more inclusive like IYR, because XLRE is intended to be a sector ETF for the S&P 500. Why don't you prefer VU over SPY? VU doesn't track very well. Well, I shouldn't say it doesn't track very well. Mathematically, I don't like the price of VU versus SPY. SPY I know is 1/10. Nice and simple. This doesn't track very well, and its options are illiquid. Okay, correct me if I'm wrong. I remember one of your videos probably 2 years ago. I believe I heard you say U.S. is the only Fed in the world that has 3 mandates. Well, full employment, price stability, and the equity market. When I said that, I do remember saying something like that. I was saying it more as a joke, because it seemed at that time that the Fed was very concerned about the level of the equity market. And they had been for quite some time. So it just seemed, I just threw that in there kind of like an insult to them, more like a joke, right? Is this still correct? And if so, well, it's not correct anymore. They don't seem too concerned about the equity market. I guess politically is one with the upcoming elections. I don't know what that means. Also, the threat of ever strengthening U.S. destabilization of other countries' currencies, economies. If U.S. comes down, will that fuel the move into U.S. equity simply because there's nowhere else to go? Well, if there was nowhere else to go, the U.S. dollar wouldn't drop. It's when there is some place to go, then money would leave the safety of the U.S. dollar. So you'll know that there are other alternatives if the U.S. dollar starts selling off over an extended period of time, like selling off significantly, like you see the dollar index going to 112, 110, 108, 106. At that point, if you're just looking at that, you would conclude that, well, there must be alternatives. There must be alternatives other than being in the U.S. Dollar for whatever reason. So I don't know that you could get a sell-off in the U.S. dollar with a rally in the U.S. and a conclusion that it's because there is no alternative, because if there wasn't, well, then the U.S. wouldn't be selling off. Next one, I assume new construction sales are a small percentage of total home sales. Well, they're not the majority. I wouldn't say they're a small percentage, but they're not the majority of total home sales. Individuals haven't come to terms with the reality of new prices, but if they represent the majority of the supply, aren't they more in control of market prices? I don't know that I don't know that the dichotomy here is about who's more in control of market prices. Sellers right now, at least in this region, are removing their listings. There's actually decreasing supply as each month goes by, and not increasing supply. Why wouldn't the builders anchor to higher prices? Who says they're not anchoring to higher prices? That's not the point that I was making in the you have to look at what it is that you're buying. It could be that the builders are charging more once you control for square footage, once you control for amenities, once you control for the quality of the flooring that you're getting, the quality of the windows, the quality of the kitchens and bathrooms and all the amenities. It could be that existing homes offer a better value than new homes. It's just that a 4-bedroom house with a finished basement, with a walkout, a walkout finished basement with a pool in the backyard and upgraded kitchen, that's what it is. You cannot suddenly say, I like the house, but I don't want to spend $900,000. Well, how much is it without the finished basement? Well, you can't do that, but you can go to a builder and say, my budget is $600,000. What can you build me? Now, dollar for dollar, the $900,000 house might have been a better house dollar for dollar, but your budget's $600,000. So I don't know that they're more in control of market prices in that sense. And I don't know that builders aren't anchoring to higher prices. It's not higher prices that I want to see a builder get. It's margins. It's their gross margin. I want to see them get higher gross margins. If they could sell $100,000 houses with 40-point gross margins, I'll buy that company, because that is huge demand at $100,000. You're going to get huge demand. If you can do that at 40-point margins, fantastic, right? So it's the margin. When you're buying a company, it's not its revenues, it's its margins. Look, I can open a business and sell iPads for $5, and my revenues would be killer, but I'd be losing money, right? So I don't know that higher prices really matter. It's higher margins. And if somebody has a fixed budget, well, a home builder has a lot more power to deliver something to that budget than an existing home does, because if your budget is $600,000, you have to choose from existing homes that are $600,000 that may have features that you could probably forego, but you're going to have to pay for. I'm wondering, would it be feasible for pensions to buy interest rate options? That would be a drag on return. That would cost money, rather than using swaps to hedge downside rate risk. It would obviously downside. We'll just say downside risk. It would obviously add cost, but eliminate margin call risk that exists using swaps. Yeah, that's the problem, right? It adds costs. Insurance costs money. And if it costs money, it's a drag on return. You have an even harder time reaching your mandate, which is to fund the liabilities as they come due. Okay, if the goal is demand destruction, I'm thinking a stronger dollar should help take out this excess liquidity in other countries whose currencies are depreciating, and therefore get to a recession sooner. Take out excess liquidity in other countries. I imagine, I'm going to cross that out. It reads better if we say would reduce demand in other countries and get to a recession sooner. If this is the case, why would a country like Canada want to match its rate hikes with the Fed? I don't know if that is what Canada's doing. I don't think it's matching its rate hikes with the Fed. It may look that way because they've had the same types of rate hikes, but I don't think Canada is saying, let's do what the Fed does. I think Canada is saying, well, we're going to do our own thing. I mean, they did go 100 basis points and then 75. The Fed never went 100. So the Bank of Canada is doing the Canadian thing. It may look like the U.S. thing, but the North American market is highly correlated. So our market is very correlated with the U.S. market, being that we have a lot more energy and materials in our economy. We're a little bit more cyclical than the U.S. I don't know that we're doing what the U.S. is doing, so I'm going to reject that line there. Also, it is possible that most countries with reserves start selling the dollar to buy their own currency. That's a possibility, sure. If this happens, does it necessarily cause the Fed to pause its rate hikes? I don't even know if that would have any effect on the Fed's thinking about pausing its rate hikes. Unless we make the argument that if other central banks are driven to the point of having to liquidate their US dollar reserves to prop up their currency, that could potentially become destabilizing. But I think that the US central bank would open up swap lines for the US dollar first before it decided that it was going to change its own domestic policy because of something going on in another country. So I don't know. It might cause the Fed to do something about it with other central banks, but I don't think it's going to change its domestic policy. Next one, about the current bond market. What would have been the right decision to make to profit from this situation? Well, we did that back in end of December of 21, beginning of January of 22. I said TLT was sitting around 158 to 160. And I said, go out long term and sell the 135 calls. What surprised me was how fast we got to 135, and that we're flirting with 100 now. At the beginning of the year, I never would have expected 100, but here we are. But the way that you would have done it was either sell calls. This is an in-the-money call, so as the price is dropping, you're making the money all the way down to 135. Cheaper than shorting the stock itself because of the borrow fee and the dividend that you would have to pay by being short. If you expect rates to continue to go up, the appropriate thing is to short duration, which means find a bond with a very high duration and short that. If you're looking at futures, ZB is the 30-year bond. TLT tracks the 20-year. There is ZN if you want futures for the 10-year. Although the 10-year and the 30-year are sort of, the 30-year is probably a better one to work with, although it's not, it's less volatile than on interest rates than the short end of the curve, but because of high duration, it ends up being a better play. I want to attach 2 links to an article, but I can't, and it gets deleted. Yeah, I've clicked the button to delete external links, and it's gotten rid of the porno sites. And in my restricted words, I have variations of Bitcoin, and because they use addresses like expert Miss Janice, it's either MS or MRRS. Very few people use those, so I put those in the list. And honestly, this week I've hardly had any spam. I've had to delete one set of crypto spammers, I think 2 porno links, and that was it. Compared to the week before, like this week was unbelievable. And the interesting thing is when I looked at comments held for review, YouTube looks like it stepped up, and it had a whole bunch of them for review that were porno sites and crypto things with the explanation of likely spam. So it's nice to see that YouTube has done something about it, but the timing seems odd because I said it in a video that they seem unwilling to do it, and then suddenly they start doing it. I don't know. I think Google. I think they read my email, and I think they listen to my videos. They must have some algorithm that listens. Here's how you can tell that Gmail is reading your emails. Very, very simple to do if you have Gmail. Send an email to your friend saying, I am looking at buying Frigidaire model XJ5625, whatever. Put something in the email. And the next time you're browsing the internet, you're going to see an ad for exactly that thing. Tell me that they're not reading your email. They're reading your email, let me tell you. All right, I was going to read it as a younger, mindless experience. As a younger mind / less experience in the markets, could you please touch on why the markets in 2000, 2008 were rallying into rate hikes? In the context of curriculum I've learned and the way you've explained it in videos, it makes sense why equity and bond markets are selling off as the Fed increases rates. So I'm confused why it was the other way around for both the previous recessions. It wasn't that they were the other way around for the previous recessions. These were correct leading into the recessions. It's this one here that is out of alignment with the others. It is we can't go with if A then B. If interest rates go up, then equity prices go down. It's not an if, it's a why. Why are interest rates going up? If they're going up because the economy is expanding and inflationary pressures are increasing, well, equities will continue to rally into that. And bond prices will be soft as interest rates rise, which means equities up, bonds up. There's that negative correlation between equities and bonds that we've had for a long time, which has broken down since since the financial crisis. So it's because economic activity in leading up to both of these were increasing. Well, right now we have economic activity that is slowing down, but inflation is way higher. So why are we raising rates this time? It's to destroy demand, to kill inflation. Here it was to slow down a very strong economy. We don't have a very strong economy right now. We have a kind of economy, a slowing economy. Some would even say, some who say, well, it's a weak economy. Some are even saying we're already in recession. So it's not if rates go up, equity prices go down. It's why are rates going up? If they're going up because we have a booming economy, equity prices will continue to go up. I know you've covered this before, but any further thoughts on currency hedging, U.S. exposure if you're a foreign investor in U.S. stocks? Yeah, you buy futures. So if I have U.S. exposure, let's say in my portfolio I have some U.S. dollar exposure, and there are CAD futures. I can buy CAD futures. And as the U.S. dollar gets stronger, my CAD futures, as the U.S. dollar, not get strong, as the U.S. dollar weakens, my CAD futures increase. Lose money here, gain money here, that's the hedge, right? So you just buy your own currency futures against the U.S. So the deliverable under here, or at least the other side of this futures contract is the U.S. And I believe for most futures contracts, they're against the U.S. So if you're euro-based and you buy U.S. stock, you would buy euro futures against the U.S. so that if the U.S. dropped against the euro, your euro futures would increase. The best way I can see to do this might be with currency futures. Yes, although you would be paying for this somewhere through the futures price, settling back to the spot price at expiration. Yeah, it depends on if you have what the forward points look like. So sometimes they're at a premium, sometimes they're at a discount, sometimes they're at par. So Canada, the US are pretty much on par because our rates, our interest rates on the short end of the curve are pretty much the same. So if you look at a 1 month futures, 2 month or 3 month, our 1 month, 2 month, 3 month rates across the board are fairly even. So we have we basically pretty much on par with where the spot happens to be. So there's no gain or loss in there. But if you have to buy at a premium, you lose the roll down to spot. No matter where it goes, you'll lose that the difference between that and the spot. But you can always account for that and say, well, you're saying down here 1.2% per year, you can just adjust your futures to have that much more. Actually, it's probably better with a forward contract. Futures aren't that divisible, but you can do that. If you have IB, let's say that you have euros and you buy US stock. Most brokers would convert some of your euros to US so that you have US stock. IB doesn't do that. You have euros, let's say you have 100,000 euros, and you buy $50,000 of US stock. You will then have USD negative 50,000 in your account. It'll give you actually a negative dollar position in your account when you do that. So if there's interest that you then have to pay on that. So even though you're saying there is a cost to getting this done, there is a cost that exists anyways. So that the cost of getting that done is probably the same cost you would have. You know, IB would be paying you interest on your 100,000, but charging you interest on the 50,000. But if you used a futures contract to hedge out this amount, these two would offset each other anyways. So being that money everywhere is making some kind of cash rate, it wouldn't matter. Okay, with the advances in technology and most people now having access to share trading accounts on their phones versus 2008 and 2000 recessions, with retail investors essentially will retail investors limit the maximum drawdown by buying the dip? Well, that's assuming that retail investors you know, are braver and bolder than institutional investors and far more willing to accept risk and suffer further drawdowns than institutional investors. That's making a big assumption. Retail investors typically are weak-hand investors, meaning that they're usually the first to fold. Usually the first to fold. I don't know that the technology and the access to trading accounts matters as much as the collectivization of the retail trader through things like Wall Street bets. What I think institutions have known for a long time is if a bunch of people are going to get into something, you want to get into that thing as well because you can ride the wave. But retail investors never had that kind of society, let's say, or that group, or that you were in the know. But with Wall Street bets, you can suddenly start to get a whole bunch of people on one side of the trade. So sometimes it makes sense to trade with the crowd if you believe that the crowd is going to do what you say it's going to do. But be careful about that, because it only takes one institution to figure out that they can game you on that, like Bed Bath & Beyond, and they will slowly take away your money. I don't know that retail investors would limit the maximum drawdown. I'm not willing to say that. Additionally, won't life insurance companies also face similar issues as UK pension funds, as they have high duration liabilities? No, they won't. No, they won't. Which, for a simple reason, it's ownership of assets. Insurance companies have something called a reserve account, which is meant to be very conservative, and that reserve account is meant to meet future liabilities as they come due, whatever they happen to be. Well, all the money in here belongs to the insurance company. It's the insurance company's money. They're managing it for themselves. So taking an active position is not a political thing to do. No politician is going to say, oh, you were playing with so-and-so's money. It's their own money. They're free to play with whatever money they want to play with. So they were more likely to have an active position and to have an intentional duration mismatch with their liabilities, so that they would have probably lowered the duration on their assets in anticipation of rising interest rates. Whereas if you are a pension fund doing that, the pension fund doesn't own the assets. The pension fund is only a caretaker of the assets. The owner of the assets is not even the company that gave the money to the pension fund, because the pension fund is a separate entity altogether. So let's say that you have a company that has a defined benefit pension plan. They give money to a pension fund. It is a separate company altogether. The liabilities to pay the pensioners are the liabilities of the pension fund, not the company over here. And the assets are the assets of the pension fund, and the managers manage the assets for the pensioners. That's a fiduciary responsibility. They don't own those assets. So if they make a mistake, well, yeah, that's a big deal. Whereas over here, the insurance company owns these assets. They're free to do whatever the hell they want with their assets. They can take active positions. Now, they can take active positions over here, and if it works out, well, there's no upside. There's no upside really, because all of this belongs to the pensioners. However, if it doesn't work out, there's huge downside for the fund managers. So when you're faced with something that has no upside but lots of downside, the solution is, well, I'm just not going to take that bet, right? Whereas here, this company gets all the upside and all the downside. So it has an asymmetric payoff, if you will. But here, the payoff is asymmetric. They're not going to take the chance. So no, insurance companies while they engage in LDI, are different than pension funds because they own their own assets. Lastly, the Australian RBA seems to be the first to slow down the pace of interest rate rises against market expectations. This will encourage other central banks to start slowing the pace of rate rises. I don't know. As I said on Sunday, I think that the Fed is closer to the end than what they're saying, because they cannot say it, because for some reason the U.S. market, more than any other market, is massively forward-looking, more than almost any other market. The U.S. market anticipates and prices in, which is exactly what the Fed does not want to happen yet. If I need a door to stay closed for the next 3 weeks, I can't have you opening it early. I have to tell you that you will lose your life if you open that door, which is not true. You won't lose your life, but it'll screw me up. Okay, so I gotta say stuff to make sure that is the last thing you want to do. I believe the Fed is near the end of its rate hiking cycle. So I think that if they do a 50 and a 25, let's say, or even a 50 and a 50, they get to 4 to 4.25, somewhere around there. I think that's it, because it is the higher level for a period of time that will work on inflation. So you can think of it this way. You can think, well, we can raise rates really high to crush inflation, or we can take rates, here's the yield curve. Let's just take the yield curve to a different level and leave it there for a while, and it's the length of time that can cure inflation. I think they'll opt for this. So I do think that we're probably done by the end of the year. RBA may be more willing to let the market know that, but the U.S. being the largest market in the world is probably not willing to do that. At least the Fed's not willing to do that. Let's see. Do you see S&P 500 going up with the dollar so strong? Well, it does make the U.S. market expensive in other currencies. Yes. I guess companies will start seeing unexpected losses on their sales. Well, I'll take the on there. They'll see expected losses not on their sales, but on the translation adjustment. So if they sell something in euros, they'll still sell something in euros. However, when they translate those euros into US dollars, because they do have to translate, even if they don't repatriate. In other words, they can have a euro division, and everything can stay in Europe. And Europe could be highly profitable, but they have to translate those assets, revenues, and expenses into a consolidated statement. Well, in translating, you're going to have what's called translation losses. They're not real losses in the sense that, oh my God, you lost money and it's gone. It's losses in the sense that the exchange rate is not what it used to be. We haven't experienced the loss. We still have all those euros. We still have all these US dollars, but these euros are not worth what they were in US. That's where you get the translation loss. But over time, longer periods of time, it is expected that those will reverse, and that at some future periods you'll have translation gains. So only if they repatriate will they be hit with actual losses? Then those are what are called transaction losses as opposed to translation losses. But yes, there will be lower earnings reported because of translation losses. However, that's always taken care of in something called adjusted EBITDA. Right? Adjusted EBITDA. Watch that. It's a non-GAAP measure. That's the one that probably want you to pay attention to. Looking at SI and volume on an ETF gives an appropriate picture of the market. I'm not sure what you mean by appropriate, given that other market participants can be using SPX. SPX is an index, so you'd have to be using futures, right? If you're trading an index, you're either going to have an index product like an ETF, or you're going to have futures on the index. By definition, short interest on futures is 50%, because someone has to be short for someone to be long. It's a contract between two parties, one who's short, one who's long. You can't have a futures market where 80% are long, because, well, who are the other 20%? Like, somebody has to be on the other side of the contract. So by definition, the net positioning in all futures markets is neutral, because every long requires a short. So at any given time, if you say how many people are short index futures, I would say half of them. By definition, half of them are short, half of them are long. So there is no real short interest that you can look at here and say, aha, it's, what you can do is you can look at positioning of funds to see if they're net long or net short, assuming that perhaps the other side is the market maker who then hedges out that position. And that might give you an indication of net long or net short positions by looking at fund positioning. Again, you're making the assumption that the other side of the contract is going to be the bank. So you can't trade an index. There has to be some product created for you to trade the index. SPY is the product to trade that index. It is the main one to trade the index without going into the futures. And again, with futures, it's 50-50. So there's no information in the futures. You would have to have fund positioning. Well, that's not as readily available information as short interest is. Okay, what are your thoughts on the rule of 20 with respect to market valuations? Not much. I'm aware of it. It's not a rule. It's an observation. The observation of 20 suggests that markets may be fairly valued when the sum of the PE ratio and the inflation rate is close to 20, and that over the years markets have shown a tendency to revert to a sum of 20 for these two metrics. Well, so you have two series. You have, if you look at the PE ratio over time, it's a mean reverting series. If you look at the inflation rate over time, it's a mean reverting series. So if you add two mean reverting series, it shouldn't be surprising that you get a mean reverting series. Duh. Right? And the mean reverting series of 20 would be take the average and take the mean reverting level of each, add them together, you'll get 20. Well, duh. You could do that with anything. You could take two mean reverting series, add them together, and come up with a rule of something. It's not a rule, it's an observation. When something is a rule, I think of it in terms of there being some relationship between the two that causes them to be so. Well, there's nothing that causes it to be 20 other than math. Take the sum of two mean reverting series, add the two mean reverting levels together, and you should get 20. Over the years, it's ranged from a low of 14 to a high of 34. But the longer term average PE is 20. Well, there's your mean reverting level there. The average inflation rate is 4%. Well, I don't know so much over the long term, what the long term is, but probably a little lower than that. But okay, so that's your mean reverting level, and comes close to 20. We're at 26. I don't know if we're at 26. I think we're somewhere around 16 over here. And 8.3, I can accept 8.3. That's year over year. I'd probably say it's closer to 7.9, so you're 23.9, 24. So what? You know, it's ranged from 14 to 34. Is 20 fairly valued? Let's say that I have an index. Let's say the market suddenly was all tech stocks with 50% growth expected for the next 10 years and inflation was 0%. Would the market trade at 20 times earnings? Probably a lot higher than 20 times earnings, right? It would be massively undervalued at 20. So you just need to think of a counterfactual to make that a false statement. Let's say that we expected there to be anemic growth for the next 10 years, that the S&P is going to grow at about 3% per year for the next 10 years. And that we are expecting, let's say, deflation of 10%. Would the market trade at 30 times earnings? No, right? It wouldn't. So when you take this series and you add this series to come up with a mean reverting level, this mean reverting level has no fundamental meaning. In other words, you can't make statements like, if the market were going to grow by this, what would that level be? You can make statements about this level and you can make statements about this level, but the sum of two levels added together does not create an emergent property. An emergent property being something that you can't attribute to any of the parts. You can completely decompose this into its parts, which means the sum of the parts has no extra information that the parts themselves do not have, in which case I dismiss it. It may be an observation, but again, you can get that same observation by taking any two series that have mean reverting levels and adding them together, whether they have meaning added together or not, and you would get the same regularity. Mathematically, you would have to. So I say nay. Thanks for the video. The market, JP Morgan, Goldman Sachs are expecting China to walk away from its strict COVID lockdowns, gradually opening the border up, which helps ease the supply chain pressure. Demand perspective, do you think the opening might drive up demand on energy and extend sticky inflation? Well, this is not part of sticky inflation. This is part of flexible, and this is part of headline, and sticky, we usually talk about core. So this would have no effect on this unless higher energy prices for longer found its way into production costs, which then became embedded. But this price would have to keep rising for the sticky component to be constant, because you'd have to have base effects, right? And this would be, if you expect it to be 4%, that means there'd have to be increases of 4% on a continuing basis. But if prices do this and they adjust to a higher level, well, the inflation rate will do this, and then over time, see what happens is you'll have massive inflation, but they'll disappear because of base effects, and then if prices just move to a new level and then stay constant at a higher level, you have no inflation. Inflation is an increase in the price period over period. So to have inflation, it's not enough for prices just to jump once. They would have to jump, and they would have to continue moving in the same direction at the same speed over time. So no, I don't expect that. The other thing is we anticipate that this is true. That after November, after Xi becomes emperor, or king, or whatever he wants to call himself at that point in time, that he can then turn his back on trying to please people. It's a communist party. Do they think about pleasing? Does it matter? Does it matter if they need to please people? I don't know that it matters. Is this going to stop? Big question mark. I don't know. And just because the election is over, that's not going to fix the housing market in China, which is the big problem right now. You have to have an economy that reorients itself from having 28%, roughly 28% of GDP in housing, down to 14% or even 12%. Where are you going to get the rest from? That's the big deal, right? Where can you get the rest of growth from? You got to get it from somewhere else. And I don't know that any of that is going to fix housing. I don't know if this is entirely true or not. And this, unless we have some reason to think it's going to just keep going up and up and up and up, is not going to really do very much on sticky inflation, because it's not part of core and it's not sticky, it's flexible. Anyways, that takes us to the end of another week of questions.